Good day, and welcome back to the Life License Qualification Program video series as presented by Business Career College Corporation. Again, my name is Jason Watt, and what we're going to be working through in this particular series of videos is individual taxation. Now, you don't have to be an accountant to pass this course, but I do think that it's useful to understand some of the basics of individual taxation in order to understand how most of the products that we're going to look at throughout the course will work. I also find, on a personal note, that even though for most of us income tax is the single greatest expense that any of us will have in our lifetimes, most of us don't ever really understand it. So we're going to work through this understanding of personal income tax. Now, to be clear, it is personal income tax that we're going to discuss here. We're not going to be talking about sales tax or excise tax. We're not going to talk about property tax or probate tax or land transfer tax. In this course, we will talk about probate tax or probate fees, but otherwise we are very little concerned with those other taxes that we sometimes deal with. Provincial premium tax is one that also comes up in the course to a very small degree. Personal income tax you do have to know to some extent. I do not want you to memorize a bunch of tax rates. Don't go to the tax tables and memorize exactly what rates a taxpayer is going to be taxed at. Okay, so income tax. What does that really mean? Well, we're taxed in Canada on almost all forms of income. So, like it or not, you're going to be taxed on your salary. You're going to be taxed on bonuses. You're going to be taxed on commission. You're going to be taxed on self-employment income. You're going to be taxed on almost every dollar that you earn. You're going to be taxed on investment earnings or investment income. You're going to be taxed on rental income. Very difficult to earn a dollar without having it taxed in your hands. Now, we avoid double taxation for the most part under Canadian tax law. That is, you earn a dollar, it'll be taxed in your hands once. Now, if you go and invest that dollar and it earns more money, then that more money will be taxed in your hands, but those are new dollars. But the dollar that you already earned that was already taxed is only going to be taxed the one time in almost all cases. It's hard to find situations where we have true double taxation in Canada. There are some sources of income that are not going to be taxed. Notable for this course is that life insurance proceeds and under most situations disability insurance proceeds are earned by individuals on a tax-free basis. Almost all insurance benefits, almost everything you look at in this course is going to be received tax-free. Winnings are tax-free as well, but otherwise virtually everything is taxed. Inheritances, I should not fail to mention inheritances. When you receive an inheritance, that is also not taxed. We don't have a death tax per se. We don't have a estate tax. We don't have an inheritance tax in this country, although when you die and you haven't paid all your taxes to that point, Revenue Canada does add up your total tax bill and they will hit you with that. So there are taxes to pay when you die, but it's not an extra tax because you died. It's just the taxes that you would have paid eventually had you lived. Okay, so these are some of the more common sources of income. What would happen for a taxpayer? We add all this up. So we come to a total here. We add this up. We arrive at a total income. Now, that total income is part of how we're going to derive your taxes payable, but Canadians are not taxed on total income. We're taxed on what we call net income. So before we apply any kind of taxes, we are first going to take something away. We're allowed actually to have some deductions from total income. Now, there are really two sets of deductions, but for the purpose of this course, we can lump them all together. Most people are not going to have access to a ton of deductions, but there are some common deductions that we do have access to. I will show you 3 deductions here. And they're really 3 that are relevant for the purpose of this course. The first, and the one that I would suggest most people have at least some experience with, is an RRSP contribution. It's not only an RRSP contribution that generates a deduction like this. This would be any contribution to a tax-deferred savings plan, such as the RRSP, a registered pension plan, or a deferred profit sharing plan. Those would all generate a tax deduction. Contributions to a registered education savings plan, a registered disability savings plan, or a tax-free savings account do not generate a tax deduction. So we could have an RRSP contribution. If you are self-employed, that is, you have self-employment income, then you also can have some deductions related to business expenses. Certain employed people who earn some commission income can also have business expenses, but it tends to be the self-employed that have the greatest access to business expenses. Some of you might be using this course as a business expense, for example. So RRSP contribution, business expenses, and the third would be the costs associated with borrowing to invest. So what does this mean? Well, let's say that we take this taxpayer, we have a sample taxpayer, and we add up all these sources of income. And we arrive at $70,000 of total income. Okay? If there were no deductions, this person would be taxed as if they had earned $70,000. But with this RRSP contribution, let's say that this person makes an RRSP contribution, and you'll see much later on in Module 14 that this person could contribute up to 18% of this $70,000 of total income. So they would be able to contribute up to $12,600 to an RRSP. Let's say this person puts $5,000 into an RRSP. That would generate a $5,000 tax deduction. At the same time, let's say that this person has borrowed $100,000 to invest. They've borrowed $100,000, maybe through the efforts of somebody who does what you do. And just to make the math easy, let's say that this person is paying 5% interest on their $100,000 loan. They're going to be paying $5,000 in interest per year. Now, in order to qualify, this $100,000 has to be invested in a non-registered account. That is, it can't be in an RRSP, it can't be in a TFSA, it can't be in any sort of registered account, in any sort of tax-favored account. So it's non-registered, and there has to be, after much fighting actually between Revenue Canada and taxpayers, there has to be what we call an expectation of profit, which means rental income or dividend income or interest income, some sort of regular profit that you generate from that $100,000 investment.